Feroze Azeez, we missed you yesterday, joint CEO Anand Rathi, but it's great to have you with us today. And just help us understand, the budget sentiment that seemed absent, and of course, all the sort of negativity around raising the STT on the F&O derivatives space sort of spooked investors, some were saying yesterday. But this morning, things are looking a little better as markets are digesting the larger fine print of budget 2026, isn't it?
Yes, Kartik, I missed being on your show as well. It's an honor to be with you, at least the subsequent day to a budget. Yes, you're absolutely right. The market was far more upset than it deserved to be, in my opinion, because, of course, the trading volumes can come down on the future side. Price discovery becomes a little more difficult. That's my belief, point one. Point two, STT is a very unfair tax. So it's not actually about STT. It is about not being pro-capital markets. See, already we are the most inefficient derivative market. I'll tell you why, and I'll back this up with data. Okay, you go to the Nifty 50 stocks. There's one stock which will quote at a 10% premium per annum in terms of roll cost. There's another stock at a discount.
Okay.
This or 2% premium. This should ideally not exist in the top 50 stocks because an arbitrage fund with 1.5–2 lakh crore AUM should get out of that stock which is giving a lower arbitrage and move to a larger arbitrage.
Absolutely right.
It doesn't happen because the transaction cost eats away most of this differential.
True.
When I asked a fund manager, why would you be in a stock which is giving you only 2% till expiry?
It's because of the STT.
STT.
And now that has been hiked.
That has been hiked. So
right.
The disparity of roll cost in Nifty 50 companies. Now, mind you, those are the top 50 companies of the country. How would, as an FII, if I'm sitting in the US, if I would say that if the collateral damage to save a retail investor and demotivate him, if you're going to do collateral damage to inefficiency and bring in inefficiency in the market, one, which is not very pragmatic. Second, why should an arbitrage fund as a community of investors pay 800,000 crores more to deter a trader?
Absolutely.
Right? He's not taking the risk. So this is not seeming logical.
You're right, Feroze. And if I can just add a little bit of perspective there for our viewers, that perhaps, the retail trader dabbling in F&O may not be on those small volumes that impacted by a second decimal point change. But the arbitrage funds that you're talking about are the ones which, for them, every single tick in the second and the third decimal place makes a difference.
Absolutely. So people, if the ministry forgot the fact that there are four kinds of people: individual speculators, institutional high-frequency traders who are also sometimes speculators. Third is arbitragers. Fourth are hedgers.
Right.
Now, if somebody is issuing a structured product in India on Nifty, he has to hedge his liability. He's got nothing to do with speculation. He has a liability. He's hedging that liability for the next 3 years.
Right.
So he keeps rolling over 36 months. Now he pays a larger cost. To deter one community, you can't penalize the other two, who are actually 60% of the market.
Right.
So that's one. But I personally think this is a buying opportunity because the trader fraternity, the FI fraternity, has already sold on the pretext of all the global uncertainty. So there's not too much left in their hands to express their displeasure. Is why today you see some degree of stability. If they were still having lots and lots of money, the active FIIs, not the passive ones, they would have dumped more today.
Right.
So they're upset, but they don't have too much stock
to show how upset they are. Right, and I think that is the kind of buying action that we are seeing today, because cheaper valuations, obviously, after yesterday, the markets had tanked. But I want to understand from you, did Budget 2026, Feroze, have anything in it to attract FIIs or even FDI, for that matter, back into India? Because one was expecting that there are going to be at least some policy announcements on ease of doing business, on assurance of capital return, which would have at least motivated some money to come back into India, especially at a time when we are seeing the kind of depreciation in the Indian rupee.
Yes, Kartik, I think one nuance which is not being spoken enough, which can bring in some stability in the small cap stocks in the year and a half or two to come, unless they change it back again. If they do, the buyback tax, everybody is excited about the reduction in tax to a retail investor. That's actually very little a quantum. So a retail investor was anyways not in the 30% slab, right? There are 3.5 lakh people in a country this large with a greater than 1 crore form 16. So coming back, I am very excited about the buyback tax being differentiated for the
Right.
promoter, corporate promoter, and the individual investor, not because of the tax saving, but the frequency of buybacks will suddenly shoot up. They had come down. See what used to happen. Now let's assume you're a listed company. Kartik Rai is the chairman of a board of a listed company. He sees 2,000 crores in his reserves.
Yeah.
He sees FIs have dumped his stock. He wants to extinguish. He wants to buy back the stock, reward the shareholder by a buyback, and extinguish the stock, and it in turn, as a collateral benefit, shores up the stock or gives stability or gives exit to somebody by participating in the open market. Now here you see the NSE small cap 250 stocks total balance sheets in terms of reserves is
Yeah.
one of at the peaks.
Yeah.
Now they're not able to do buybacks, so the frequency of buyback going up is what excites me rather than the tax differential for the buyback.
All right, so that definitely seems like one green signal coming for investors as far as the budget goes. At this moment, let me also introduce Mohit Gang, co-founder and CEO of Moneyfront, who joins me on the show. Feroze, do stay with us for a moment more. But Mohit, I want to first understand from you, also, in addition to this share buyback, which is definitely potentially a positive, there's a major negative which has come as far as personal finance goes, and that is about buying sovereign gold bonds, the SGBs, from the secondary market, and they're going to be taxed as capital gains on maturity. Now, that was a very, very smartly hidden feature within the budget. But overall, the government is obviously feeling the pinch with the sovereign gold bonds. But for investors in that instrument, a big negative coming from the budget?
Hi, Kartik. Good morning. Always a pleasure to be on your show. So look, I think, yeah, there are these kind of googlies hidden around in the budget, which always appear post facto.
Yeah.
And I think this SGB buyback, or sorry, the SGB taxation was one of such clauses. Honestly, I think, look, to clarify the effect first, anyone who has bought SGBs in the primary market as a direct issuance from Reserve Bank of India, the taxation is, there is no taxation, right? So that continues as is. But because of the kind of abnormal gain, which I think government thinks that investors have made in this instrument, and obviously the government outlay on this instrument at maturity will be massive. I think they're just wanting to collect or mob back some amount of that gain via taxes. So if anyone has bought SGBs in the secondary market at maturity, now these will be taxed as capital gains. Yes, it's a dampener, but the kind of returns investors have made this in this instrument is astounding. And because of that, I think there was a lot of secondary demand and a lot of high premium going on in the secondary market on SGBs. So my sense is that premium might disappear now because of the taxation. And look, you can argue it both ways. This wasn't necessary, but from a government's perspective, I think they just want to collect back as much as possible from this instrument because they're losing a lot in this one.
Right, stay with me, Mohit. Feroze, while we're talking about gold, let me also get your perspective on both gold and silver. The kind of volatility that we've seen, first the astronomical rise and then a historic crash like we haven't seen after 1980. Overall, for let's say, retail investors at this moment who were first living in FOMO that they've missed the rally and now they're thanking God that they did not participate at those levels, what should they do now? Which direction are commodities likely to take from here? And what should their asset allocation with respect to commodities look like?
Kartik, I've been saying this one thing which I'm repeating on your channel, that silver is not silver at all. Okay, there is a very profound thing I'm trying to say here. Okay, it's difficult to understand. Silver is not silver. Silver has become a trading underlying in Chicago Mercantile Exchange to gamma traders. Gamma traders are those who are not worried about the direction of the underlying. Like one of the institutions which SEBI alleged that they used in Bank Nifty, that's the exact same trade which can have been identified by the gamma buildup. What is gamma buildup? In an options market, the options which are there out of the money are a very high gamma instrument. So, of course, in the world of AI, I can use a word and let it be and not worry about explaining, because the viewer can actually go to one of these AI platforms and ask them to explain it.
Sure.
So what I'm trying to say is that silver is not silver. That's why an asset behaves very differently in a specific period of time.
Okay.
Right? Gold has never behaved like this in the billions of years.
Right.
Why did it behave at a volatility of 72 standard deviation for the last 7 months? It was not because it was gold, it was a gamma trader. Why did Oracle in the US on a specific day, 11th September last year, go up 42%? Why did India's Infosys ADR go up 37% on one result? Those are all gamma squeezes one has to understand. So if you want to be in gold, you have to stagger. You can invest in gold, but if you stagger it in 12, 14 months, you will actually buy gold and not the gamma of gold.
All right, so buy gold, not the gamma of gold. I'll also have to use some AI to really understand the details of that. But Mohit, what exactly are you advising your clients at this moment? We were talking about asset allocation, in the end of December last year, and I think we had come to some sort of a conclusion that potentially a little more allocation towards commodities might be a better strategy for 2026. Are you still on the same page, or do you think the traditional sort of 70-20-10 is a good asset allocation as far as 2026 goes, especially in the post-budget and the kind of volatility that we've seen in commodities?
Oh, absolutely, Kartik. I stand by what I have reiterated on multiple forums during the year-end asset allocation view. So I'll just again repeat. Number one, we are extremely bullish on large plus mid-cap kind of universe. We are completely out of small caps, and I think I've repeated at number of forums that small caps for me this year is a no-go zone unless market shows a comprehensive sign of rebound and momentum, which perhaps could be second half of the year, but we'll have to look and assess that. On the commodities front, I think it's been a very categorical call from our end. I think the first time when silver touched or breached $80 $80 an ounce mark, that was a time when we gave a loud shout out to all our clients for profit booking. And we continue to maintain that stance that silver is now in a completely frenzied zone. It's a highly speculative zone, so one has to trade out there in extreme caution. But on gold, we remain extremely positive and bullish with a 3 to 5 year kind of a view. There could be interim corrections, but from a risk reward perspective, as compared to silver, we are extremely bullish on gold. And given the geopolitical setup, given the global narrative, given the way countries are trying to align with each other, and whatever, given if at all there is some merit in the de-dollarization concept, I think if there is something out there, then it will all catch up and build up in the coming 3 to 5 years. And my sense is gold will continue to hold steady during this phase. So it's a hedge against the system. It's a hedge against the dollar hegemony. It's a hedge against the US tantrums currently. It's a hedge against the geopolitical tariffs and the geopolitical risks currently. It's a hedge against your currency, and it's a hedge against any other global currency, right? So gold continues to, for me, remain a bullish call. Yes, you have to be cautious given the volatility, given the kind of frenzy which is happening in both the commodities. But I agree with Feroze on that count that you have to cautiously get into the metal. On a slightly lower time scale, my sense is maybe 3 to 6 months is something which where investors can again look up to build gold. And I'll stay away from silver for some more time.
All right. Okay. I have two final questions since we are really decoding, the impact of budget 2026, especially on the common man. I'll ask one question each to the two of you. Feroze, first up, that reduction in sort of, the custom duty when it comes to personal items from 20% to 10%. In spirit, does it go against the concept of Atmanirbhar Bharat? Because the government does seem to be sort of assuaging the concerns of the depreciating rupee. So now foreign imports for personal use coming at 10% import duty, rather 20%. But does it go against the spirit of Viksit Bharat Atmanirbhar?
I don't think so. These small tinkerings are generosities, which are logical.
Okay.
Right? If you look at what the government does to shore up exports, you look at those iPhone lines of assembly. We today export $23 billion of iPhones, up from 17 just a year back. 2017, we were importing iPhones.
Right.
So there is a lot of balancing factor. So you distribute benefit, concentrated gain is a concentrated by a balancing factor is always good. So you distribute the gain of what you've done from 2017 in electronics.
All right.
By exporting iPhones.
Okay, so generosity is the word coming in. And finally, Mohit, my last question to you this morning, that TCS reduction on foreign travel, on foreign education, on foreign medical treatment, now overall coming down to 2%. This was a very, very controversial sort of, TCS introduction about 2 years back. But the fact that the government is trying to now rationalize that, a move in the right direction?
Oh, absolutely, absolutely. I think the intent when it came in was only to figure out people who are doing consistent foreign travel and spending a lot abroad or
Okay.
overseas, right? So you can actually get the data by 2% also. You need not charge them 10%, 15% for that effect, right? It was a drag on travelers. It was a drag on education as in students. It was a drag on many fronts. And I think even 2% to me is a higher number. But yes, I'll take it with both hands, whatever comes.
All right, well, let's leave it at that. Feroze Azeez, Mohit Gang, thank you so much. As always, a pleasure speaking to the two of you and for really simplifying all the fine print of Budget 2026, especially when it comes to personal finances and the markets. Thank you so much for your time.